that's what you need to instill confidence. So my math is take M1, take 40% of M1. That's the dollar amount of gold you need to have a strong gold standard. Divide it by, the number of ounces in 8,133 metric tons, and you get a number. And that number today is around $23,000. So, but it keeps going up. And the reason it keeps going up is that the gold supply is constant and the money supply keeps going up. So again, fifth grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear,
Jim Rickards, a renowned economist and investment strategist, has consistently championed gold as a hedge against economic instability. Initially, he predicted that gold could rise to $15,000 per ounce. However, after further analysis, Rickards has recently revised his target to approximately $23,000 per ounce. This adjustment is based on his assessment of the U.S. M1 money supply, which currently totals $17.9 trillion, alongside the historical gold backing ratio of 40%, a standard maintained by the U.S. Federal Reserve from 1913 to 1946. Rickards argues that, to back the current money supply at this historical ratio, the price of gold would need to rise substantially, highlighting a significant imbalance between the expansive growth of the money supply and the finite supply of gold. Given the record levels of government debt and rising inflation risk, Rickards suggests that the U.S. could eventually be forced to reconsider a gold-backed monetary system to restore confidence in the dollar. Gold has historically served as a reliable store of value during times of economic turbulence, such as during the 2008 financial crisis, when gold prices surged as investors sought safe haven assets amid market turmoil and the collapse of financial institutions. In future scenarios where inflation becomes uncontrollable or the US dollar loses its status as the world's primary reserve currency, Rickards believes that the price of gold could rise dramatically as the demand for a stable store of value increases. In an extreme scenario where fiat currencies lose credibility entirely, he even suggests that gold could reach as high as $223,000 per ounce. To protect against these systemic risks, Rickards advises investors to allocate part of their portfolios to physical gold, such as bullion or coins, rather than relying on paper-based gold investments like ETFs or derivatives. Physical gold, he argues, offers a tangible, non-digital asset that is insulated from market volatility, government intervention, and the risks associated with financial institutions. Now, we present the clips of Jim Rickards' insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
For a long time, go 5 or 6 years, I had I said gold could go to $10,000 an ounce, and recently I revised that upward to, you do the math, you can update it, but kind of $23,000, $25,000 an ounce. I should explain what that is. It's not well, it will get there, but it's not a hard forecast like, buy gold because it's going to $10,000 an ounce. Instead, it's an expression of it answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold? In other words, whether you want a hard gold standard or soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. We can do calculus, but this is kind of 7th grade math, or at least where I went to school. So basically, take the money supply, and right away you run into problems. Everyone thinks they know what money is. Well, no, the Fed doesn't know what money is. They have M0, M1, M2. They have all. Whenever you see 5 different measures of money supply, it tells you right away that the Fed doesn't even know what money is. But anyway, I use M1. M0 is base money. That's the money the Fed prints, but it doesn't mean very much because they print it by buying securities from dealers, and the dealer sends in the 10-year notes or 5-year notes, and the Fed pays for the securities with cash. And that money does come out of thin air. That's not just a metaphor. It does come out of thin air, and they pay the banks. The question is, what do the banks do with it? They give it back to the Fed in the form of excess reserves. So all you're really doing, you're expanding both sides of the balance sheet. You're piling on Treasury securities, and you're piling up liabilities in the form of excess reserves. But that money is sterilized. It's not doing anything. No one's getting to spend it. And there's no velocity. The money that does matter, the money that does drive the economy, doesn't come from the Federal Reserve. It comes from the commercial banks. And that's M1. It includes bank deposits and so forth. So I use M1. And then we know the amount of gold the government has, 8,133 metric tons. People go, it's all in Fort Knox. Actually, it's not. About half of it's, a little less than half is in Fort Knox. The rest is at West Point. There's a vault there. Can't disclose the location, but it's there. And people ask me all the time, say, "Hey Jim, who owns the gold? Is it the Treasury or the Fed?" And I say it's the Army, because they're both Army bases. I mean, West Point and Fort Knox are both. I mean, the legal answer is the Treasury owns it, but it's stored in Army bases. So M2, I don't know the number off the top, or M1, sorry, I don't know the number off the top of my head. You can just go to the Fed website. And 8,133 metric tons, break it down by ounces, divide one by the other, and you, one more assumption. How much gold backing do you want? Now, the hard shell Austrians will say 100%, if it's not, it's leverage, or, it's not a solid standard. Historically, that's not true. Great Britain, backed up by the Royal Navy, ran a very successful gold standard in the 19th century. They had about 20% backing. At any given time, the Bank of England had about 20% backing for their notes. The United States used 40% backing until around the end of World War II, and then they went to 25%. And they ended up at zero by the late 1960s. But it was either 40% or 25%. So, take your pick. And the British were about 20%. That's what you need to instill confidence. So my math is take M1, take 40% of M1. That's the dollar amount of gold you need to have a strong gold standard. Divide it by, the number of ounces in 8,133 metric tons, and you get a number. And that number today is around $23,000. So, but it keeps going up. And the reason it keeps going up is that the gold supply is constant and the money supply keeps going up. So again, fifth grade math, you're going to get a larger and larger number of dollars per ounce in order to back up a higher dollar amount with the same amount of ounces. So it's about $23,000. So just to be clear,
Jim Rickards highlights the unique characteristics of silver as both a precious metal and an industrial commodity, making it more complex to analyze than gold. While gold primarily functions as a store of value and monetary asset, silver has significant industrial applications, especially in sectors like solar energy and electronics. This dual nature means that silver's price often lags behind gold in the early stages of a bull market, especially during periods of economic downturn when industrial demand for silver is weak. However, as economic conditions improve, silver tends to catch up, often surpassing gold in price growth during the later stages of a rally. Rickards believes that silver will likely follow suit if gold experiences substantial price increases driven by inflationary pressures or a weakening US dollar. He forecasts that, in a scenario where gold prices reach $10,000 per ounce, silver could hit $40 per ounce or higher. This pattern follows historical trends where silver has lagged during the initial phases of a precious metals bull market, but outperformed gold once the broader economic situation leads to increased investor demand for safe haven assets.
I spend a lot of time analyzing gold, not so much from, I do invest in gold mines. I've been in gold mines and know a lot about the production side of the business, but my main interest has always been gold as a monetary asset. The truth is gold's not good for much except money. I think it's the best form of money. But you say, well, what else can you use gold for? Well, jewelry. Well, okay, jewelry is just a form of wealth that you wear. You see an Indian bride draped in gold chains. It's beautiful looking. Yeah, but that's her dowry. That's her down payment on the house. That's the kid's college education. So jewelry is just just a different way to store bullion. But so gold is not good for much except money. Silver is different. Silver is a precious metal. It can be a form of money, has been, and still is, but it has a lot of industrial input. So when it's an industrial input. So when you're analyzing silver, you've got the precious metals analysis on the one hand, but you have industrial input on the other. And that makes it tricky because if you're in a recession, let's say the price of gold is going up, silver will tag along. Silver will be along for the ride. And you're exactly right. It tends to lag and then it shoots up. But in a recession, silver is going to lag or even go down a little bit because of reduced industrial demand. So it's harder to analyze because you have to balance one against the other. On balance, the way I think about it is subject to timing differences. If gold performs the way I expect, silver is along for the ride. So you'll get to $40 silver, and sooner than later you'll get to put it this way: the world of $10,000 gold is the world of $100 silver. But the other thing I do is I offer investors suggestions for part of their portfolio, not all of it by any means, but have a slice of precious metals, have some silver, some gold, fine art, land, natural resources, alternative investments, etc. Have a set of assets that are, first of all, hard assets, meaning non-digital. I'm not saying all silver and gold for sure, but have these other things as well. But the point is non-digital assets that are not going to be frozen or seized or caught up in the kind of collapse or vulnerable to the power grid outage. I have all these Bitcoin people. I'm like, how does that work when the power's out? That's a separate conversation. We can take that to the bar. But the point being, it will protect you against the kind of scenario I'm describing. So again, diversify your portfolio in a way that makes you less vulnerable. And for the regulators, think about a cybernetic approach that could be less of a blunt instrument than slamming on the brakes. And that may be the best we can do. But the real best we can do is to understand the danger. Like I say, I'm not saying get out of the stock market. I'm warning people these are landmines that you need to be aware of.
Given the current economic climate, including rising government debt and persistent inflationary pressures, there is growing speculation that gold prices could reach $23,000 per ounce by 2025. This prediction is based on the possibility of a shift toward a gold-backed currency system, which would require gold to account for a significant portion of the money supply. As governments struggle with unprecedented debt levels and central banks continue to print money, confidence in fiat currencies could erode, pushing investors to seek safe haven assets like gold. If inflation worsens, or the US dollar loses its position as the world's primary reserve currency, gold could experience a substantial price surge. While this forecast is speculative, it highlights the growing role of gold as a hedge against economic instability, and investors should consider the potential for significant price increases in the years ahead. Please share your thoughts on Jim's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.